Picture this, a seemingly perfect start to the day. The sun is streaming through your window, casting a warm glow across your room. You stretch, yawn, and reach for your phone, ready to embrace the possibilities of a brand new day. Little do you know, the digital world has a surprise in store for you, a surprise that will test your resolve and challenge your understanding of the markets. It's Friday, the sun's out, you're sipping iced coffee, enjoying the simple pleasures of a relaxed morning. The week's stresses are fading into the background as you savor the moment, anticipating a weekend of leisure and perhaps a bit of profit-taking from your wise investments. The birds are chirping, the air is fresh, and life feels good. And you check your crypto portfolio expecting gains? You tap the app icon, the screen flickers to life, and you brace yourself for a wave of green numbers, a testament to your savvy investment choices. You're ready to bask in the glory of a successful week, perhaps even treat yourself to something nice. Instead, you see a sea of red, a stark and unsettling contrast to the sunny optimism of the morning. The numbers are not green, but a deep, alarming red, indicating significant losses across the board. Your heart sinks as you try to make sense of what you're seeing. Bitcoin down, plummeting faster than you thought possible. The leading cryptocurrency, the bellwether of the market, is bleeding value, dragging the rest of the crypto ecosystem down with it. The red candles on the chart paint a grim picture of a market in freefall. Ethereum tanking, mirroring Bitcoin's descent into the abyss. The second largest cryptocurrency, often seen as a more stable alternative, is proving to be just as vulnerable to the market's sudden downturn. The losses are mounting, and the sense of unease is growing. Dogecoin in the gutter. The meme coin that once soared on viral hype is now crashing back down to earth, leaving a trail of shattered dreams and empty wallets in its wake. The speculative frenzy has come to an abrupt and painful end. The news? Israel strikes Iran. A geopolitical shockwave reverberates through the global markets, sending investors scrambling for safety. The specter of war looms large, casting a dark shadow over the already fragile financial landscape. Suddenly your Lambo dreams are replaced by panic. The visions of luxury and financial freedom evaporate in an instant, replaced by the cold reality of potential losses. The fear of losing everything grips you, and you're not alone. This isn't just a bad day, it's a full-blown crisis unfolding in real time. The market is in turmoil, and the sense of panic is palpable. Red screens flash everywhere, a constant reminder of the value that is being wiped out. It's the reality of June 13, 2025. A day that will be etched in the memories of crypto investors for years to come. A day when the promise of decentralized finance collided with the harsh realities of the real world. The world of decentralized finance got a harsh lesson, a painful reminder that even in the digital realm, the laws of economics and geopolitics still apply. The decentralized dream is being tested like never before. Even in the metaverse, you can't escape real-world conflict. The digital and physical worlds are inextricably linked, and events on one side of the globe can have a profound impact on the other. The illusion of separation is shattered. The market, usually driven by hype and memes, suddenly faces a much more serious challenge. The playful banter and lighthearted speculation are replaced by a grim awareness of the potential consequences of global conflict. Had to price in the threat of war. The algorithms and trading bots struggle to quantify the impact of such an unpredictable event, leading to increased volatility and uncertainty. The market is struggling to find its footing. The result? Pure chaos. A whirlwind of sell orders, cascading liquidations, and panicked reactions. The market is in a state of disarray, and the future is uncertain. Crypto's promise of independence, its supposed immunity to the whims of governments and central banks, is being put to the ultimate test. Can it truly withstand the forces of global conflict? Shattered by missiles thousands of miles away. The physical destruction of war has a direct and immediate impact on the digital world, highlighting the interconnectedness of our global society. We went from debating proof of stake, the intricacies of blockchain technology, and the potential of DeFi, to a much more fundamental question: how to protect our assets in a world on the brink of war. To Googling safe haven asset in seconds. The search engines are flooded with queries for gold, silver, and other traditional safe havens, as investors desperately seek a refuge from the storm. Tourists panic sold, cutting their losses and fleeing the market in droves. The inexperienced investors, lured in by the promise of quick riches, are the first to abandon ship. Veterans set stop losses, or screamed with more experience. The seasoned traders, hardened by years of market volatility, react with a mixture of calculated risk management and primal fear. This wasn't a dip, it was a crash, a sudden and catastrophic collapse of the market, wiping out billions of dollars in value. The scale of the losses is staggering, fueled by fear, the irrational and contagious emotion that drives market crashes, turning rational investors into panicked sellers. In crypto, a tweet can send prices soaring, a testament to the power of social media and the herd mentality of the market. But a headline can send them spiraling. The news media, with its ability to amplify fear and uncertainty, can have a devastating impact on market sentiment. Unlike stocks, crypto never sleeps. The global market operates 24 hours a day, 7 days a week, offering no respite from the relentless volatility. So neither do its traders, the dedicated and often sleep-deprived individuals who monitor the markets around the clock, trying to navigate the turbulent waters. Welcome to the future of finance, a world of decentralized ledgers, smart contracts, and digital assets, where fortunes can be made and lost in the blink of an eye. Thrilling, innovative, and anxiety-inducing. A roller coaster ride of emotions driven by market volatility and the ever-present fear of the unknown. If you thought crypto was immune to global drama, that it existed in a separate self-contained world, you were sorely mistaken. Think again. The events of June 13, 2025, serve as a stark reminder that the crypto market is not immune to the forces of the real world. Let's break down what actually happened. Let's delve into the details of the crash, examine the underlying causes, and try to understand the lessons that can be learned. Buckle up, because this is going to be a bumpy ride. To understand the crash, rewind. Israel and Iran's rivalry is decades old, a simmering feud of covert ops and proxy wars. The spark, an alleged Israeli airstrike on an Iranian consulate in Syria, a major diplomatic no-no. Iran retaliated with over 300 drones and missiles at Israel. Most were intercepted, but the message was clear: escalation. On June 13, Israel struck back, targeting military sites near Isfahan, a hub for Iran's nuclear program. The world panicked. Fears of a regional war soared. Oil, trade, and global stability were suddenly at risk. Investors everywhere hit the panic button. Risky assets, tech stocks, and crypto were dumped en masse. The digital world collided with harsh reality. The news hit, and crypto didn't just dip, it plummeted. Bitcoin plunged over 8%, slicing through $60,000 like it was nothing. Ethereum dropped over 10%, falling below $3,000. Altcoins? Obliterated. Solana, XRP, Cardano, Dogecoin, all deep in the red. Over $200 billion in market cap vanished in a day. The real pain: over $1 billion in leveraged positions liquidated as prices crashed. Forced selling triggered a cascade, pushing prices even lower. In crypto, there are no circuit breakers. Panic spreads instantly. The lesson? In a crisis, crypto is still the riskiest playground. When fear takes over, it's the first place investors flee. June 13th proved it. The cryptocurrency market recently experienced a significant downturn, leaving many investors wondering, why did crypto get hit so hard? What were the underlying factors that contributed to such a dramatic plunge in value? Let's delve into the key reasons behind this market turbulence. It's all about risk-off sentiment. In times of uncertainty, investors tend to shy away from assets perceived as risky, and crypto often falls into this category. This risk aversion is a fundamental driver of market behavior during periods of instability. When war looms or geopolitical tensions escalate, investors instinctively seek safety. They flee risky assets for safe havens. Gold, the traditional store of value; oil, a crucial commodity that often sees increased demand during crises; the US dollar, the world's reserve currency, offering stability and liquidity. Crypto, despite its digital gold reputation, which some proponents have long argued for, still trades like a high-risk tech stock. Its price movements often mirror those of growth-oriented technology companies, making it susceptible to market downturns. Leverage made it worse, amplifying the impact of the price decline. The market is loaded with borrowed money, used by traders to magnify their potential gains, making it fragile and vulnerable to sudden shocks. As prices fell, leveraged positions were liquidated, forcing traders to sell their assets to cover their debts, triggering a vicious cycle of forced selling, further depressing prices and exacerbating the market decline. The Israel-Iran news, with its implications for regional stability and global energy markets, was the pin that popped the bubble. Human psychology played a huge role. Fear is contagious, and it spreads rapidly through the market. Headlines about airstrikes and war, painting a picture of potential global conflict, trigger panic selling. as investors rush to protect their capital. The crypto market, full of retail investors, many of whom are relatively new to investing, is especially vulnerable to emotional waves driven by fear and uncertainty. Herd mentality takes over, with investors blindly following the crowd, and everyone rushes for the exit, trying to sell their holdings before prices fall further. The result? Catastrophe. A rapid and widespread decline in asset values. In crypto, emotion moves faster than logic, often overriding rational decision-making. This crash was a masterclass in how quickly fear can unravel the market, demonstrating the power of sentiment in driving financial outcomes. And it won't be the last time. Market cycles are inevitable, and understanding the dynamics of fear and risk aversion is crucial for navigating the volatile world of crypto investing. So, your portfolio's wrecked. What now? For many, it's meme time. Crypto Twitter explodes with "this is fine dogs" and distracted boyfriend memes. It's not just silliness, it's how the community processes pain and stays sane. Memes become a shared language, offering comfort when charts are bleeding. The absurdity is real. While world leaders scramble, traders Photoshop laser eyes onto jets. Dark humor helps us shrug at the chaos. It's a coping mechanism that unites the community. Gallows humor lightens the mood and keeps despair at bay. When the world is burning, sometimes all you can do is laugh, and in crypto, that's survival. The market's a dumpster fire. Should you sell everything? Not so fast. Volatility creates opportunity for those who stay calm. Rule 1. Risk management. No reckless bets. Be disciplined. Use stop losses. They're your safety net, not your enemy. Stable coins like USDC or USDT can act as a parachute. No gains, but no losses. Move some funds to safety so you can buy back in later. Stay informed, but don't obsess over every price tick. Get news from reliable sources, set your plan, then step away. Remember, markets are cyclical and fear fades. Strong projects recover first. Don't let short-term chaos destroy your long-term vision. Touch grass, breathe, and keep perspective. Survive today to thrive tomorrow. It's not just retail investors. Big players get hit too. Coinbase, the largest US crypto exchange, saw its stock tank with the market, but they're playing the long game, hiring political heavyweights to lobby for crypto-friendly regulation. The real battle is in Washington, not just on the charts. Meanwhile, celebrities like Shaquille O'Neal are learning hard lessons. Shaq settled a lawsuit for promoting the collapsed FTX exchange. Celebrity endorsements can turn into legal nightmares when things go south. For investors, the lesson is clear. Don't buy just because a star says so. Do your own research. The fallout from FTX is a warning. There are landmines everywhere. Even when war isn't crashing the market, risks remain. Brutal market? Deep breaths. First, stay calm. Panic selling locks in losses. Zoom out. Crypto has survived worse. Volatility is the price for big returns. Ask yourself, has your investment thesis changed? If not, maybe do nothing. Use this as a learning experience. Did you over-leverage too many risky coins? Refine your strategy, allocate smarter, set stop losses, and plan for crashes. Don't let headlines wreck your mental health. You control your actions, buy, sell, or hold. Stick to your plan, invest only what you can afford to lose. Crypto is chaos. Embrace it, but don't let it control you. Be patient, be smart, and keep your eyes on your goals. The world is wild, but you can navigate it. Survive, adapt, and thrive. After the dust settles from a major market event, when the initial panic subsides and the frenzy fades, what's the lesson we should take away? What critical insights can we glean from the experience? The reality is that crypto, despite its aspirations of complete decentralization, is still inextricably tied to the old world, to traditional finance. Geopolitical conflicts, fluctuations in commodities markets, and the decisions of central banks all exert a significant influence. The original dream of a completely separate, self-governing financial system, operating independently of these traditional forces, isn't a reality yet, and perhaps won't be for some time. Crypto, in many ways, sits right in the front car of the global economic roller coaster, experiencing every twist, turn, and drop with amplified intensity. But that inherent volatility and interconnectedness isn't a reason to bail out of your positions entirely. This recent crash, while painful, exposed the immaturity of the market, the dangers of excessive leverage, and the prevalence of herd behavior driven by fear and speculation, but it also demonstrated remarkable resilience. The market, despite the doomsayers, didn't die, it persevered. Blockchains continued running smoothly, processing transactions and validating blocks without interruption. The community, battered but not broken, adapted, innovated, and began to rebuild. Smart, experienced investors understand that maximum fear in the market often translates to maximum opportunity for those who are prepared to act strategically. However, don't just blindly ape in based on hype or FOMO. You need to have a well-defined strategy in place to navigate and capitalize on black swan events. Diversify your portfolio across different asset classes, rigorously assess your risk tolerance and adjust your positions accordingly, and consider allocating a portion of your capital to safe haven assets like gold. Think of this market downturn as a stress test, an opportunity to identify and patch your weak spots in your investment strategy and risk management. Remember, sensational headlines will always shake the markets, creating fear and uncertainty, but your primary job as an investor is to see past the short-term noise and focus on the long-term fundamentals. In the world of crypto, a certain degree of chaos and volatility is not a bug, it's a feature, an inherent characteristic of this nascent asset class. Learn to anticipate it, understand it, and ultimately, learn to ride the waves of volatility to your advantage.